3 minutes to go to open the market. The Dow's down 150. That's because of Boeing. Keith Fitz with me now. Okay, Keith, you like Nvidia, even though it's at $500 a share, $495. You think it's going higher than that?
I do. I think it's going higher, but I also think this is the year where we're going to see a split, because one of the things management has got to do is make that stock more accessible. 80+% market share, AI is expanding, data centers are moving. I think it's a great play this year. If they were to announce a split, the stock would go up, I think, very quickly. I think it would. I think it'd run ahead of the split, but also don't remember how splits work. You know, after they split, they tend to attract a lot more capital. So I think it's an interesting play. It's one of the very few I'd look at before the split as opposed to after.
Josh, I obviously am going to go to you first. A+ is the second big test, right after Palo Alto got the poor grade. Not Nvidia, A+. Jensen Huang, accelerated computing and generative AI have hit the tipping point. He said, you said this was the whole ball game going in.
Yeah, I really felt that way. And look, it's not important whether you bought Nvidia or you sold Nvidia or anything in between. What really matters is that you acted emotionally, as we could all attest. That's really what you're going to want to do here, is follow your heart. Most people went into this report, myself included, saying there has to be some incredible quarter. Like, there's just no way this stock can continue to levitate higher if they don't knock it out. And that's really what they did. I don't think anyone's really arguing with that. I saw the sell-side research, Judge. I saw a couple of firms say, okay, everything's great, but it's reflected. I didn't really see anybody saying that they're worried about next quarter or end-of-year number. And so in the absence of that, it's more buyers than sellers. The story is old as time. Here's the most interesting thing to me. People say, well, how can you justify buying it right now? Well, if you could buy it last year, you could buy it right now. I'm not, but you could. Nvidia is trading at a 34 forward enterprise value to free cash flow. Sounds relatively high to other technology stocks, not high for Nvidia. In May of 2022, almost 2 full years ago, it was 43 times. In July of 2022, it was 58 times. So that number has been significantly higher than where it is right now. This is basically a stock that somehow finds a way to continually justify ever higher prices with the actual fundamentals. It's very rare. There aren't a lot of examples of this.
I'm glad that you hit the valuation thing head on, because we had the conversation, you and me, with Stacy Rasgon, Bernstein, yesterday going into the print.
He raised his target. I told you he would.
He did. And we put this to him about this argument about whether Nvidia is too expensive on a price-to-earnings ratio forward. Here's what he told us.
Tesla may be buying back its shares, and it's all because of Nvidia. Now, Nvidia's stock is buzzing with talk of another split. The graphics card giant hinted this recently, and everyone is talking about it. But the interesting thing about this topic is not that Nvidia is splitting its stock, rather its potential effects that it could have on companies like Tesla, as well as various strategies that these companies may have to adopt.
Keith Fitz joins us now. I want to talk about Tesla. Would you buy the stock if it dropped below $200?
No question about it, Stuart. I would hopefully be smart enough to buy a whole lot more of the stock if it drops under 200 bucks.
That's a dip you would buy?
Oh, yeah, absolutely. I already hold a fair chunk of it, and I'm looking to add to positions. You know, this stock has got hundreds of billions of dollars with its charging network. It's got AI. It's got the world's largest autonomous driving database. You know, this stock, I think, is going to double or triple in value in the next few years.
But it faces extraordinary competition now from Chinese imports. It faces legal challenges. And Elon Musk, is always in the news and not always in a good way. Doesn't that pull you back a little bit?
That last point is the one that concerns me, but visionaries are always like that, and you've got to make a bet here as an investor. My belief is that the company is going to set the bar for a long time to come. I may be, completely wrong on this, but I don't think so, because we've seen Microsoft, Apple, we've seen many other companies go through similar challenges at various points in their history.
So you'd buy it under 200, but you wouldn't buy it at 218 right now?
Oh, I'm still going to buy it. I'm probably going to, I hope I'm smart enough to buy it all the way down, because that's how the game is played. You add to positions when they're on sale.
Okay, tell me about Nvidia. Would you buy that stock? It's now, what, $547. Would you buy that stock on any pullback?
Yes, I would. I think that stock is going to split. It's got an 80+% market share. It's moving into India, hundreds of millions of dollars of new chip sales. AI is not going anywhere anytime soon, and that's the clear leader. So yes, same story there. I hope I'm smart enough to buy that one hand over fist as well.
Okay, we'll wrap it up there. Buy Tesla under 200, buy Nvidia on a pullback. Keith, have a great day. We'll see you again soon.
Nvidia shares hitting a record here this morning, surging over 15%, adding more than $200 billion to its market cap. Now, this coming after the company's earnings results blew past the street's expectations. The move here this morning, and also the rally that we're seeing more broadly across the spectrum, showing that the AI-fueled rally still has more room to run, at least for now. Let's talk about what it could mean as we take a look at the longer term. For that, we want to bring in Jeff Bierman. He's TheoTrade Chief Market Technician. Jeff, it's good to have you here. So there's been so much talk about the fact that a lot of the market gains that we have seen over the last 15 months or so has been driven by the hype and excitement surrounding AI. Does this pose a potential risk here to the broader market to you?
Well, first things first, Sean, I want to clarify, it's not hype. It's the real deal. AI has arrived, okay? The earnings from Nvidia are absolutely spectacular. You can comb through it and look for any negativity, but there really isn't. And they did guide higher for the next quarter. However, the question comes down to this. It's not about hype. It's about how far forward have AI stocks priced cash flow and earnings and valuations. Is it 6 months? Is it 1 year? Is it 2 years? I don't have a handle on it yet. I'll let the market sort it out. But I can tell you this. We are at overbought levels that I've never seen. And overbought is a condition. It is not a trigger, which means you automatically turn and sell. Overbought can persist, but it is a warning that the market is getting a little bit beyond FOMO here. And there's a concentration risk factor, meaning that most managers are just throwing away every stock they can to get into this AI revolution, and they're missing bargains all over the place in other sectors. So the concentration risk, to me, is the biggest risk, but AI is real.
So the concentration risk is a huge risk. We've been talking about that now for some time. So when you, I guess, break that down a little bit more for us, because those who have been calling it for it now for the last several months that they've bought in, they're actually doing pretty well. So why is it now, when you take a look at these valuations here outside of Nvidia, are you raising or really bringing more attention to the fact that this could pose a larger risk to the broader market?
Well, it calls into question traditional risk management and traditional investment management diversification. Diversification in this market is dead. It does not work. You can't tell me you're going to lay risk and spread it across 11 sectors and get a meaningful, effective return. It's not working. So what managers have done is they're just gravitating towards what's working and selling weakness to buy strength. So the market itself, if you just segregate just financials and just tech, it's about 60 to 65% of the entire market. Now, financials look fully priced, and they've been disconnected completely from interest rates. Interest rates are going higher, financials are going higher. That argument is past. You can bury that. Nobody cares right now about interest rates for the time being. So whether they're cut or raising, it's not an issue, because the earnings on tech sort of supersede and put that to rest. But if the market gets fully priced in tech and fully priced in financials at the same time, and I believe we're there with financials, then it poses a risk when there's an unwind for a corrective period, because it'll be like yelling fire in a crowded theater, Shauna.
Jeff, what are the technicals that you would look to determine whether or not, and the point at which Nvidia is finally over its skis, perhaps?
Well, I like to look at things on a 1 and 2 year basis, Brad, just standard deviation channels, 2 and 3. I like to see how far they can test beyond statistical measures, whether it's standard deviation or average true range. But truly, the RSI, not on a daily, not on a weekly, but on a monthly, is starting to approach that 75 to 80 level. In fact, it hit nearly 98 on SMCI on a daily basis just a couple of days ago, which is an all-time high record for an overbought stock.
Lately, Tesla stock has been struggling, and investors are itching for good news, something to calm their fears and reassure them of the potential behind Tesla's business. In these moments of trial, Tesla is making efforts to turn things around, and maybe a share buyback could be a way out for the car company. So the question on everyone's mind is, will Tesla do a share buyback after Nvidia's stock split? Well, buckle up, because this one's a bit of a head scratcher, even for market wizards.
And as Stacey Rascon, as Josh just said, quote, the story, this is what he says today. The story still feels like it has legs. We markedly increase estimates again and take our price target to $1,000. He was at $700, which we asked him about yesterday. He said, don't pay too much attention to my target there, but he bumps it to $1,000.
Yeah, I mean, what's so incredible is if you think about it, if you take a Google, Apple, Meta, Microsoft, and Amazon, what, $12 trillion market cap, when all of these companies get together behind the same theme, which is AI, Nvidia is the recipient of all of that, the majority of that CapEx. And so this call, if you haven't listened to the call as an investor, I implore you to go listen to the call. It was like a masterclass. And this is so exciting because I've just never seen a company that in 2021, they had revenues of like just shy of 17 billion. For 2024, they're going to do 60 billion. I just don't know of a company this size that have had just this catapult. And so investors need to remember the revenues and earnings are growing really in lockstep with the price. And so I think they're hitting on all cylinders. I will say, Scott, though, if you think about it a year from now, I don't think you're going to continue to see 200% growth year over year, because you're going to see that stabilize. But you're still even looking out even further out. This company is probably going to be growing at 15 to 16% a year. So they just continue to be in pole position while everyone else is just trying to ride their wave.
Nvidia's got a history of sharing and splitting its stocks to make it more accessible to individual investors. In fact, its last stock split was just in 2021. And now, with the stock price cruising at around $788 at the time of this video, some experts are saying that this could be another time for a spin at the split wheel. But why would Nvidia consider a stock split? Let's find out. So it all boils down to share price psychology. A high share price can feel intimidating to some investors, especially to those new in the game, and so a stock split provides a lower price point for stocks, making it more affordable for a wider audience. In the end, this can potentially increase trading volume and liquidity, which is good news for investors and the company itself. Hey guys, welcome back to Tesla Tomorrow. Here's the fun part. If Nvidia proceeds with its stock split, we think there's a possibility that this could potentially impact some EV stocks. Let me explain. While Nvidia isn't directly involved with the electric vehicle industry, they are a key player with chips that power these fancy electric rides. So positive buzz surrounding Nvidia due to a potential split could in theory spill over to other EV stocks. Think of it like this: a rising tide lifting all the boats. Investors might get more excited about the EV sector as a whole if big names like Nvidia make positive moves. But that's not exactly where we're heading in this video. Now, since Nvidia's potential stock split is causing a stir in the market, everyone's probably wondering, will Tesla, the EV kingpin, follow suit with a share buyback? Let's dive into the video and see if we can spot any signs. But before we do, if you're liking this type of content, hit that like button, subscribe, and turn on post notifications to keep up to date on everything going on with Tesla. It's important to understand the difference between a stock split and a buyback. A split simply divides existing shares into a larger number of lower price shares, although it doesn't change the overall value. On the other hand, a share buyback involves the company using its own cash to repurchase shares from existing shareholders. And this can actually increase the company's value per share, as there are then fewer shares outstanding. And now the question is, will Tesla respond to Nvidia's potential split with a buyback? Well, that's a good question, but honestly, the answer comes with a bit of maybe and a lot of who knows.
Yeah, well, I think, Dan said it, right? I think that the focus should be on the long term here. And a lot of investors currently right now are focused on the short term. Hey, look, Tesla's not immune to changes in interest rates, right? But when you look at the auto industry as a whole, they are, one of the only electric vehicle manufacturers that has this profitability. And we heard on the call that they're able to reduce costs at really an unprecedented rate, when analysts think it's over 10% a year. And they said they see further opportunity for cost reduction. So, they've cemented their lead in electric vehicles. I think if you want to talk about the next year or so, we should be talking about robo-taxis, right? We heard that Full self-driving version 12, their latest version of autonomous driving software, is going to roll out to more customers in North America soon. I think that shows confidence in their autonomous capability. And as you know, we think that's a multi-trillion-dollar opportunity. We also heard that Optimus might ship next year. I mean, general purpose robots for manufacturing alone, we think could be a $10 trillion market as a whole. So we're really excited for those AI opportunities. This is one of the greatest AI stories of our time.
And Tasha, you've been a long-term bull here on Tesla. But Dan, let's talk about what is going to happen here over the next 1 or 2 years, because 2024, it looks like from the commentary there, it's going to set up to be a very challenging year, or a challenging year, I should say, for Tesla. Is 2025, is that going to look much better?
Look, I mean, and I think, Tasha, we agree 100% from an AI perspective. That could be multiples of what the stock's worth today from an EV opportunity. But 2024, you need to hold the line on margin. You cannot continue to cut prices. I think if this is a trough period, next few quarters, then this is the low. But it comes down to the communication, because investors want to hear guidance to sort of navigate this period. When the plane's crashing in the near term, you're not focused on salted or unsalted pretzels.
You know, Tasha, when we think about what other auto manufacturers are doing as well right now, I mean, the scale has been there for years. Tesla has obviously been able to ramp up over these past few years, specifically in EVs. A lot of these other manufacturers have had to either pivot some of their ambitions or at least draw back, but they still have considerable scale that Tesla perhaps can't turn on the same way. You know, how are some of the other manufacturers, Ford, Stellantis, GM, how's what they're doing perhaps one of the larger kind of clouds that continues to loom over Tesla and the larger demand environment as well?
Well, Brad, you said it. Those traditional auto manufacturers are actually pulling back their electrical vehicle plans. And it's, again, because they don't have, they don't have the lead that Tesla has. They don't have the cost structure that Tesla has. So yes, they have scale, but not in electric vehicles, right? Some of the Chinese automakers have scale in electric vehicles. But when you look at North America, Tesla's been the lead for a long time. And by the way, it's not just about cars, right? It's about AI. It's about compute. And Tesla is years ahead of the competition there. I mean, what they're building out in terms of AI compute is going to rival many tech companies, let alone automakers. Automakers aren't even close. And you cannot talk about Tesla without talking about this robotics opportunity. And so to give you an example, right, Tesla has millions of cars on the road. They're able to access data from over 2 million miles of full self-driving behavior from customers per day. No other automaker can pull that information off of their customer cars. I mean, this is unprecedented, right? So when you think about solving for autonomy, which is the future of the auto market, and if you're not there, I don't even know if you can survive the next 5 years, 10 years. So I think that's where Tesla has this lead. And I think that we see videos of these vehicles where people don't have to intervene and it's full drives, right? So it's already possible in specific scenarios, California locations. I think that they could launch a ride-hail robotaxi service a lot sooner than people expect. And then, the margin fear is over, right? Because it totally changes the business model. This is going to be a lot more profitable than their base vehicle business.
Tesla's got a history of being unpredictable, to put it mildly. The automaker hasn't traditionally done share buybacks, but it has been focusing instead on reinvesting profits into growth initiatives. However, with Tesla's stock price hovering at around the $200 mark, it's not exactly out of the realm of possibility. So here's a potential scenario. If Nvidia splits, generate enough positive buzz on the tech sector, and boost investor confidence in growth stocks with Tesla, well, it could create a window of opportunity for buybacks. And by repurchasing shares at a lower price point, Tesla can potentially increase the value per share and reward existing shareholders. So will Tesla really do a share buyback? Well, on one hand, the stars seem to be somewhat aligned. Tesla's stock price is cruising around the $200 mark, which could be seen as a sale for repurchasing shares. Plus, some investors have been practically tap dancing on Tesla's doorstep, requesting a buyback after multiple stock splits and a dip in market value. And let's also not forget that Tesla's got a good chunk of cash lying around, just waiting to be spent. so that could be a good reason to buy some shares back. But let's not get too excited, because this is where it gets a bit tricky. Tesla isn't exactly known for following the traditional script. In fact, the automaker has historically been a bit more of a growth at all cost player rather than being in the buyback game. The focus has been more on expanding production, developing new tech, and sometimes sending rockets into space. And then there's the whole unpredictable leadership factor. We all know Elon Musk is the man behind the Tesla wheel, and he's got a rep for making bold and unexpected moves, so it's actually impossible to predict his approach for a buyback. Also, it's important to remember that Tesla has a lot going on right now, ramping up production of the Cybertruck to expanding into new markets. The car company might be more focused on internal growth rather than a buyback. So ultimately, the decision to do a buyback rests solely on Tesla's leadership. They'll need to weigh in a number of factors, including market conditions, their financial health, and future growth plans. And while it is interesting as a possibility, a Tesla share buyback in response to Nvidia's split remains a bit more of a speculative game rather than a guaranteed move.
The tech-fueled rally continues, although losing a little bit of steam today, but Nvidia hitting a $2 trillion valuation and setting a record for the biggest daily market cap gain this week. And this comes after the chipmaker handily beat analyst expectations in its earnings report and guidance. Markets riding high on Nvidia's win, but the rally might need broader participation to survive. To break this down for us, Keith Buchanan, Globalt Investments Senior Portfolio Manager, is here. Good to have you on the show here. So Keith, what is it going to take then to take some of the steam off of this rally that we're seeing and really broaden out some of the gains more?
Thank you so much for having me. Really, AI is as real as advertised. There's no denying that this is a revolutionary form of technology that would change every industry and how productive we are as a society. But the sheer market cap that these corporations have garnered to this point is really hard to really fathom. I mean, there are two corporations that individually have more market cap than the entire Russell 2000 small cap index. We feel like the market has become a little too top heavy. We've enjoyed some of the gains of the Mag 7, so to speak. And we don't feel like the valuation is extreme even at these levels. But we feel like this rally at this point is going to have to enjoy broad participation within value, within small cap, within mid cap, in order to continue to sustain itself later into 2024. From a valuation standpoint, we feel like that can benefit those corporations that execute very well. We saw some of that last quarter as far as earnings reports, especially guidance. I mean, we're looking at those corporations for leadership going into 2024.
And it's interesting because when you look at the price movement that we've seen in the valuations, a lot of people's wondering about that balance between rational exuberance and meme stock treatment here. So in terms of what could potentially let the steam out of this rally, what are you looking at?
Look, irrational exuberance is when we make up different new ways to justify where things are. Pex.com and price per click, price per book in some areas, price per website visit in the 90s was a symptom of that exuberance. We're just not seeing that now. The most traditional earnings metric of price to earnings on a go-forward basis, next 12 months. Nvidia's trading at 30 times earnings.
Tesla's impressive net income figures demonstrate that the car company is clearly doing something right when it comes to their business model. The EV maker is consistently able to turn a profit, even during times that are challenging for many other businesses and industries around the world due to economic uncertainties caused by the pandemic. Despite facing numerous challenges, including production bottlenecks, supply chain constraints, and skeptical market sentiments, Tesla's resilience and determination has paved the way towards profitability. The company's ability to continuously innovate, optimize operations, and capture market opportunities has allowed it to transform from a niche EV startup to a dominant player in the automotive industry. Interestingly, Tesla's profits might be explained by positive consumer attitudes towards greener transport options or simply growing popularity among stock market investors. For instance, the heavy increase in share prices has allowed Tesla to push its stock to unprecedented levels in early 2021, reaching $400 per share in November of that same year, and that surge encouraged several investors to consider investing in clean energy. Tesla still maintains this growth trajectory, even though it's not evident in its stock price. And now people may be thinking, what about Nvidia's potential stock split? Won't that influence Tesla? Well, maybe not. While the stock split may generate positive buzz, each company ultimately dances to its own financial tune, and Tesla has its own priorities in that sector. So what does this mean? Well, the potential for Tesla to do a share buyback is definitely there, and it's a bit more like a mirage in the desert. So the best piece of advice is to keep your eyes open on Tesla's official announcements and financial reports. Those will be your best bet in deciphering the future of their buyback plans, if there are any at all. Remember, in the world of Tesla, anything is possible, even if it means throwing a curveball in the most seasoned financial analyst's face.
Tesla and Elon need to focus on one thing and only one thing. I think 2024 is going to be rough. They need to scramble to find the next growth wave. $25,000 car, at least 18 months out. That may be a game changer, might get them back to 30 or 40% growth. What are you going to do in the next 18 months? And I think they got 3 shots on goal. They've got the self-driving vehicle with robo-taxis, probably still 3 to 5 years out. They've got an energy division, which most people don't even think about, and that is doing $6 billion last year, on the way to maybe $8 or $9 billion this year, going 50%. That could be a $20 billion division. And then they've got the global charging network, because everybody has basically thrown up the white flag, if you will, signed a deal with Tesla to be able to use their global charging network. They've got to make one of these 3 things work to get the growth cycle back. That's what Elon should be evaluated on. That's what the board should be setting his comp on. In my opinion, it always needs to be performance-based.
And Steve, I want to ask you, switching gears here a bit, a different question. Musk's SpaceX wants to convert its business incorporation to Texas from Delaware. Wants to do the same thing with Tesla. Does that move make sense to you, Steve?
Look, I have no comment on whether they should be in Delaware or Texas. They should be focused on one thing: moving faster, getting new product into the market that is lower cost, that can compete with BID, which is clearly far and away, full stop, their number one competitor. All the legal issues, the tax issues, the control issues. Generally speaking, you want to be focused on making a great product at a lower price and doing it faster than anybody else. Every minute you waste on other stuff, I think, is suboptimal. They've got their work cut out for them, and the Chinese are coming, and they're coming quickly.
Steve, even given your concerns about the growth trajectory, it's my understanding you don't own shares of Tesla anymore.
That's correct.
You tempted, as you see them go down, if you are optimistic about them maybe gaining in the future, or why don't you have them anymore?
Well, look, long term, I think Tesla has a bright future. First, every auto company in the world is going all electric. And that's happening just because the cost of batteries are going down. People used to pay a premium to buy electric. It was a green premium. It used to be $20,000, $30,000. Then it was $5,000 or $10,000. Last year it was $2,000 to have an electric vehicle, $2,000 more on average than internal combustion. This year, it'll probably be less, and it'll be less for the rest of our lives. Why? Battery costs are going down. So the world's going that direction. He's the leader in the sector. That's great. But what companies get based on is the slope of their growth curve and the percent of gross margins. Give Tesla a lot of credit, 16 consecutive profitable quarters, but the growth curve has slowed. That's the big issue there. I think that's what comp should be based on, is getting back up the growth curve. If he does that, Tesla's going to look like a winner.
And Tesla, known for its innovation in the EV industry, has captured the imagination of both investors and consumers. Its pioneering efforts in sustainable energy solutions have propelled it into some of the most valuable company situations in the world. However, before taking any action, investors must delve deeper into the company's financials and strategic direction. Evaluating company fundamentals is essential to understanding Tesla's current position and its ability to generate consistent returns for shareholders. And key aspects to consider could include growth revenue trends, profit margins, cash flow generation, debt levels, competitive landscape analysis, and management's track record. Also, it's important to remember that correlation doesn't equal causation. Just because Nvidia stock split doesn't guarantee a magical boom for all things electric. Each company's performance is ultimately determined by its fundamentals and market dynamics. So, will Nvidia split its stock again? We don't know for sure. There is talk about a buzz in the industry from this stock split, and it could have interesting ripple effects beyond just the world of graphics cards. But it's good to remember that we shouldn't get too excited, because when it comes to stocks and the stock market, anything is possible. What do you think? Let us know down below, and if you want to know more about what Tesla's been up to over the last few days, go ahead and click on this next video on your screen. See you there.